Not every error in financial reporting carries the same weight. In auditing, the concept that helps us separate the minor from the significant is materiality. Think about it this way. Not all information matters equally. Some details are trivial. Others are important enough to influence judgment. Materiality is the threshold that helps auditors determine when a misstatement becomes significant enough to matter. Auditing standards tell us that a misstatement is material if it could reasonably be expected to influence the economic decisions of users of the financial statements. That means materiality is not just about the size of a number. It is also about context. It requires professional judgment. For example, a $100,000 error might be insignificant for a large multinational corporation, but that same $100,000 error could be highly material to a small local nonprofit organization. So here is the key takeaway. Materiality is not absolute. It is relative. It depends on the size and nature of the entity being audited, and that is why understanding materiality is essential. It helps auditors evaluate findings and focus attention on what truly matters. Thank you for watching. Stay tuned for more bite-sized lessons in accounting and auditing.